What if I told you that the biggest companies in America are legally allowed to manipulate their own stock prices? That billions of dollars are being funneled into the pockets of the ultra-wealthy using a trick that was literally considered fraud just 40 years ago? And what if the same financial maneuver that helped trigger the Great Depression is now the backbone of our entire economy? Sound crazy? Stick around, because what you're about to discover will completely change how you see the stock market. But first, if you want to uncover more hidden financial secrets that shaped our world, hit that subscribe button right now. Trust me, you don't want to miss what's coming on the Monetary Archaeologist. Here's something Wall Street doesn't want you to know. There's a multi-trillion-dollar magic trick happening right under your nose. It's called a stock buyback, and it's probably the most powerful wealth transfer machine ever created. But here's the twisted part. It used to be illegal. Executives who did this went to jail. Companies got destroyed. It was considered one of the dirtiest tricks in finance. So what changed? How did we go from arresting people for this to celebrating it as smart business? The answer involves a stock market crash, a one-page rule change that nobody noticed, and the complete transformation of American capitalism. Let me take you back to where this whole mess started. Picture this. It's the 1920s, and America is drunk on prosperity. Jazz music fills the air, money flows like champagne, and everyone, I mean everyone, is playing the stock market. Factory workers are buying stocks. Shoe shiners are giving investment tips. Your grandmother's pooling money with her friends to gamble on Wall Street. The New York Stock Exchange isn't just a market anymore. It's a casino where everyone thinks they're winning. But behind the glittering facade, something darker is happening. Corporate executives have discovered a cheat code. They're using their company's money to buy their own stock, artificially pushing prices higher and higher. It's the perfect scam. Create the illusion of success, watch investors pile in, then cash out before anyone realizes it's all smoke and mirrors. Think of it like this. Imagine if you could bet on yourself in a race, then pay someone to put rocket boosters on your shoes. That's basically what these companies were doing. And for a while, it worked beautifully. Stock prices soared. Fortunes were made overnight. America looked unstoppable. The party seemed like it would never end. Until October 1929. When the music stopped, it stopped hard. The stock market didn't just decline, it collapsed. Companies that had been propping up their own stock prices suddenly couldn't afford to anymore. The artificial support vanished, and prices went into free fall. Panic spread like wildfire. Investors who thought they were rich discovered their wealth was an illusion. The companies they trusted had been manipulating prices all along, and now the truth was brutally exposed. Banks failed, businesses shut down, life savings evaporated overnight. Within 3 years, unemployment hit 25%. A quarter of American workers had no job. Families stood in bread lines just to eat. The wealthiest nation on earth was brought to its knees. And one of the culprits? Companies buying their own stock to create a false sense of security. The public was furious. How could this happen? How could the system allow such blatant manipulation? Something had to change. Enter Franklin D. Roosevelt in 1933. The new president looked at the smoking ruins of American capitalism and said, "Never again." The free market had failed spectacularly, and trust was completely shattered. So Roosevelt's team did something radical. They rewrote the rules of capitalism itself. In 1934, Congress passed the Securities and Exchange Act. This law created the Securities and Exchange Commission, the SEC, and gave it one clear mission: stop the manipulation. The message was simple. If a company buys its own stock to inflate the price, that's market manipulation, and market manipulation is fraud. For the first time in American history, there was a watchdog with teeth. Companies couldn't just play games with their stock prices anymore. The party was over. And you know what happened next? For the next 50 years, half a century, stock buybacks basically disappeared. They weren't worth the legal risk. If you got caught manipulating your stock price, you could go to prison. So companies did something different. They actually invested their profits back into their businesses. They built new factories. They funded research and development. They created products. They hired workers. They paid dividends to shareholders the old-fashioned way. CEOs were judged on what they built, not what their stock price did. The stock market reflected actual industrial power and productivity. The system wasn't perfect, but it was real. Growth meant something tangible, things you could touch, products you could use, jobs that paid wages. For 5 decades, American capitalism grew without this trick. But in the shadows, a new philosophy was brewing. In 1970, an economist named Milton Friedman published an article that would change everything. His argument was elegantly simple. The only responsibility of a business is to make money for shareholders, not to serve communities, not to take care of workers, not to build for the future. Just maximize shareholder value. To many corporate executives, this was liberation. For years, they'd been judged on employment numbers, stability, and long-term growth. Now, someone was telling them that none of that mattered. The only score that counted was the stock price. This idea spread through business schools like wildfire. By the late 1970s, a whole generation of MBA graduates believed that serving shareholders was the highest calling of capitalism. Then came 1980, and Ronald Reagan swept into the White House promising deregulation and free markets. Wall Street was ascendant. Greed was good. The government was the problem, not the solution. Let the market decide everything. Corporate executives saw an opportunity. They wanted to push stock prices higher without the slow, boring work of actually building better businesses. They wanted a shortcut. And in 1982, they got one. While America was focused on other things, the SEC made a quiet decision that would reshape capitalism for the next 40 years. They passed something called Rule 10b-18. It was just one page, no big announcement, no congressional hearings, no public debate, just a technical rule change buried in regulatory paperwork. But that single page created a safe harbor, a legal loophole that allowed companies to buy back their own shares without being accused of manipulation, as long as they followed some basic limits. Read that again. The same activity that was considered fraud for 50 years was suddenly legal. The SEC basically said, you can manipulate your stock price now. Just don't be too obvious about it. In one stroke, they legalized what generations of regulators had banned. Why? The official reason was capital efficiency. If a company had extra cash, why not return it to shareholders? But the real reason was ideology. The people in power believed markets should be free from restriction. They believed shareholders deserved maximum returns. They believed executives should have flexibility. Nobody stopped to ask, what happens when companies can legally inflate their own value? We were about to find out. Before 1982, stock buybacks were rare, maybe a few $1 billion per year across the entire economy. After 1982, they exploded. At first, it was gradual, a few companies testing the waters. Then more. Then it became normal. By the 1990s, buybacks exceeded $100 billion annually. By the 2000s, they were standard corporate practice. By the 2010s, we're talking over $1 trillion a year. Let me explain why this matters. When a company buys back its own shares, those shares are taken out of circulation. Fewer shares available means each remaining share represents a bigger piece of the company. So even if the company's actual profit stays exactly the same, the earnings per share go up. On paper, the company looks more profitable. Stock prices rise. And here's the kicker. Executive bonuses are tied to stock prices. So CEOs discovered they could boost their own compensation without actually improving the business. No new products needed, no innovation required. Just buy back shares and watch the numbers go up. It's like getting a raise for rearranging your office instead of doing better work. This wasn't capitalism creating value. This was accounting as magic trick. And Wall Street absolutely loved it. The 1990s turned buybacks into an art form. Tech companies, paying employees with stock options, started buying back shares to offset the dilution from those same options. Essentially, they were using shareholder money to pay themselves. Then 2008 happened. The financial crisis should have been a wake-up call. Banks had taken insane risks, the economy collapsed, and taxpayers had to bail everyone out. You'd think after that disaster, companies would learn to be more careful with their money. Wrong. Between 2009 and 2019, the top 500 U.S. companies spent over $6 trillion on stock buybacks. $6 trillion. That's more than they spent on all capital investments combined. More than on research, more than on expansion, more than on equipment and facilities. They spent more money buying their own stock than building their actual businesses. Even more insane, many companies were borrowing money to do buybacks. Interest rates were low,
Debt was cheap, so why not borrow billions and pump up your stock price? This is like taking out a loan not to buy a house or start a business, but to buy a fancy suit to impress people at a party. Airlines did it. Retailers did it. Even the banks that caused the 2008 crisis did it with their bailout money. The entire economy became focused on one thing: making stock prices go up, no matter what. Now here's where this gets really dark. While trillions flowed into buybacks, something else was happening, or rather, not happening. Research and development slowed down. Companies stopped investing in long-term innovation. Wages stagnated. The average worker's paycheck barely kept up with inflation, while CEO compensation skyrocketed. Infrastructure aged. Factories weren't modernized. Equipment wasn't upgraded. Why? Because all that money was going to buybacks instead. Companies were literally choosing to inflate their stock prices rather than invest in their future. And the wealth transfer was staggering. Who owns most of the stock market? The top 10% of Americans own almost 90% of all stocks. The top 1% alone owns more than half. So every buyback was essentially taking company money and funneling it to the wealthiest people in the country. The workers who actually created the value, they got nothing. In fact, many got laid off while their companies were doing record buybacks. Between 2010 and 2020, corporate debt doubled. Companies borrowed trillions, but instead of building resilience, they built illusions. They looked profitable on paper while hollowing themselves out from the inside. Then COVID-19 hit, and the house of cards almost collapsed. Airlines that had spent billions on buybacks suddenly had no cash reserves. They came begging to the government for bailouts. The same companies that had enriched shareholders for years suddenly needed taxpayer money to survive. Think about that. They had the money to buy back stock and boost executive pay, but not enough to weather a crisis. This is what happens when you prioritize appearances over fundamentals. Buybacks don't build resilience. They don't create innovation. They don't prepare you for the unexpected. They just make you look good until reality hits. And when reality hit in 2020, it exposed just how fragile the system had become. But here's the thing that keeps me up at night. Buybacks aren't just a corporate strategy anymore. They've become essential to the entire system. Stock markets don't just reflect the economy now, they are the economy in many people's minds. Politicians point to rising stock markets as proof everything's fine. Central banks watch stock prices like vital signs. Pensions depend on endless growth. And buybacks have become the fuel that keeps prices rising. Without them, markets would fall. And falling markets create panic. Panic leads to crashes. Crashes lead to recessions. So we're trapped in a cycle where companies have to keep buying their own stock just to maintain the illusion of prosperity. What used to be market manipulation is now basically monetary policy. This should sound familiar. It's the exact same pattern as the 1920s. Cheap money, inflated stocks, and faith in endless growth. We've seen this movie before, and we know how it ends. Let's talk about who really wins in this system. Every time a company does a buyback, stock prices rise. The top 10% who own most stocks get richer. The bottom 50% who own almost no stocks get nothing. Meanwhile, wages don't keep up with the cost of living.
Housing becomes unaffordable. Education costs skyrocket. Healthcare bankrupts families. The ladder to prosperity is still there, but someone removed all the rungs. And here's the cruel irony. Many workers' retirement funds are invested in these same companies. So they benefit slightly from buybacks, but nowhere near as the executives and major shareholders. It's like being invited to a feast, but only lick the plates afterward. The wealth gap isn't an accident. It's a feature of the system we've built. When you allow companies to funnel money to shareholders instead of workers, when you tie executive pay to stock prices, when you make manipulation legal, inequality isn't a bug, it's the intended outcome. So where does this lead? History gives us a pretty clear answer, and it's not pretty. Every time an economy becomes disconnected from reality, every time markets run on illusion instead of fundamentals, every time wealth concentrates at the top while everyone else struggles, the system becomes fragile. It doesn't matter how sophisticated the financial engineering is. Complexity doesn't create stability. Often it creates hidden risks. The 1920s looked prosperous until it didn't. The housing market looked solid until 2008. Every bubble looks sustainable until the moment it pops. And right now, we're sitting on the biggest buyback bubble in history. Corporate debt is at record levels. Many companies are borrowing money they can't really afford to buy stock at prices that may not be sustainable. What happens when interest rates rise and debt becomes expensive? What happens when the economy slows and companies can't afford to keep buying? What happens when the buyback machine stops? We might be about to find out. The deeper truth is this: buybacks are a symptom of a much bigger problem. We've built an entire economic system around a single idea, that shareholder value is all that matters, that stock prices are the ultimate measure of success. But stock prices don't measure how many people have good jobs. They don't measure innovation or sustainability or community strength. They measure one thing: how much money investors can extract from a company. And when that becomes the only goal, everything else gets sacrificed. Long-term thinking? Gone. Why invest in research that won't pay off for 10 years when you can boost stock prices today? Worker welfare? Irrelevant. Why pay higher wages when you can use that money for buybacks? Resilience and preparation? Wasteful. Why keep cash reserves when shareholders want that money now? The system rewards short-term extraction over long-term creation, and you can't build a sustainable economy on that foundation. Here's what really gets me about this whole story. In 1934, we recognized that stock manipulation was dangerous and made it illegal. We said markets should reflect real value, not artificial tricks. For 50 years, that principle held. Then, in 1982, we changed our minds. We decided manipulation was fine as long as we called it something else. We didn't learn new economics. We didn't discover that the old rules were wrong. We just decided that enriching shareholders was more important than market integrity. And we dressed it up in fancy language: capital efficiency, returning value to shareholders, optimizing capital allocation. But strip away the jargon, and it's the same thing that crashed the market in 1929. Companies using their own money to inflate their own stock prices. We took something that destroyed the economy and made it the foundation of modern capitalism. That's not progress, that's amnesia. The most dangerous part of any bubble isn't the mechanics, it's the belief. As long as everyone believes stock prices will keep rising, the system works. Money keeps flowing, buybacks continue, prices climb higher. But the moment that belief cracks, everything unravels. And belief is fragile. It's built on confidence, and confidence evaporates fast. We saw it in 1929. We saw it in 2008. We'll see it again. The question isn't if, it's when. Because you can't create real prosperity by shuffling money around. You can't build lasting wealth by buying your own stock. Eventually, reality catches up. The companies that hollowed themselves out to boost stock prices discover they're not prepared for competition, disruption, or crisis. The executives who got rich on buybacks retire wealthy, while the companies they led struggle to survive. The shareholders who cashed out early make fortunes, while late investors watch their savings evaporate.
This is the pattern repeated throughout history, and we're following the same script right now. What makes this moment different and more dangerous is how dependent the entire system has become on buybacks. It's not just corporations anymore. It's pension funds counting on stock growth. It's 401ks that people depend on for retirement. It's university endowments and charitable foundations. The whole apparatus of American finance now assumes stock prices will keep rising. And buybacks are the engine that keeps them rising. So we can't just stop. We're addicted. Buybacks are the drug that keeps the high going. Remove them and the whole system goes through withdrawal. Stock prices fall, portfolios shrink, retirement plans collapse. Politicians lose elections when markets crash. Central banks panic, the economy seizes up. So even though everyone can see the long-term danger, nobody wants to turn off the machine. It's like being on a speeding train where everyone knows the bridge ahead is out, but nobody wants to hit the brakes because the sudden stop might hurt. So we keep accelerating, hoping somehow it'll work out. Let me bring this home. Stock buybacks aren't just a technical financial topic. They're a window into what our economy has become. We've built a system that rewards extraction over creation, that values appearance over substance, that enriches a tiny percentage while leaving everyone else behind. A system where the same manipulation that once destroyed markets is now celebrated as genius, where companies spend more money inflating their stock prices than building their futures, where the measures of success have nothing to do with actual prosperity. This isn't sustainable.
It never has been throughout all of history. The crash of 1929 taught us that markets built on manipulation will collapse. The crisis of 2008 showed us that complex financial engineering creates fragility, not strength. And yet, here we are, doing the same things again, expecting different results. The next reckoning is coming. Maybe not tomorrow, maybe not this year, but it's coming. And when it does, it won't be because of some external shock. It'll be because we built an economy on an illusion and convinced ourselves it was real. So what's the lesson here? When someone changes the rules to make manipulation legal, pay attention. When the wealthy create systems that funnel money to themselves while calling it efficiency, be skeptical. When numbers go up but real prosperity doesn't follow, ask questions. History doesn't repeat, but it rhymes, and right now it's rhyming with some very dark verses. The story of stock buybacks is really a story about power, who has it, how they use it, and how they rewrite the rules to keep it. In 1934, we said market manipulation was wrong and stopped it. In 1982, we said market manipulation was fine and legalized it. The difference wasn't new economics, it was who was in charge and what they valued. The question for us now is, what do we value? Do we want an economy that creates real prosperity for everyone, or one that creates the illusion of prosperity for a few? Do we want companies that build for the future, or ones that cash out the present? Do we want markets that reflect value, or ones that manufacture it? These aren't easy questions, and the answers will determine what kind of economy we have when the current illusion finally breaks. If this changed how you see the stock market and the economy, do me a favor, subscribe to Monetary Archaeologist. I dig up the hidden financial history that explains how we got here and where we're headed. Because the past doesn't just inform the future, it predicts it. And if you understand the patterns, you'll see what's coming before everyone else does. The answers are buried in history. I'll help you uncover them. Hit that subscribe button, and I'll see you in the next investigation.